All right, so whether you sold some properties last year and you're thinking about your current taxes, or you're thinking about selling some properties this year and you've heard the term capital gains tax. Well, what the heck is a capital gains tax? Stick around, we're going to get into that today. Hey guys, welcome back to the channel. It is your realtor, Nick Isgro, with eXp Realty here in Central Maine. Now, as I said at the beginning, today we're going to get into what is the capital gains tax. It's a term we hear a lot, particularly around investment properties, but not always. So we're going to tell you what is the capital gains tax and talk about whether it applies to you or not, and if it does, what you might be able to do to avoid paying that tax. Right now, before I dive too deep, if you are new to the channel, I do want to welcome you here. Here we do discuss all things real estate here in the state of Maine, particularly in the Central Maine market. If that's of interest to you and adds value to your process in the real estate world, please go ahead and like this video, hit the subscribe button, knock that little alarm bell, and you'll be notified every time we put out new content. All right, so we'll jump right in here. What is a capital gain? What is a capital gains tax? So the capital gains tax is a tax that you may or may not owe on a capital gain. A capital gain is the profit or the increase, the gain that you make on the sale of any capital asset, and that would include real estate. So if you sell a house for more than you bought it for, that's great news, right? Well, yes, but you still might owe some taxes on that gain. Well, let's get into that and break it down to see exactly what that means for you. Right, so the first question you want to ask yourself is, how long have you owned your home for? Because it's going to make a difference of whether you owned it for more than 1 year or less than 1 year. If you've owned your home for less than 1 year, that's considered what we call a short-term capital gain. Now, if you've held that real estate for longer than 1 year, then you're going to have what's called a long-term capital gain, and that's good because that's going to get preferential tax treatment when it comes time to do the taxes. Now, I know there's a lot of you out there who have been selling your home for the last couple of years. You've gone through this, or you're really thinking about selling your home. You're looking out there, you see it's a great seller's market, values are up. Nick, I want to sell my home, but I don't want to pay the capital gains tax. Well, let's talk about that specifically to whether or not this is your primary residence. And this is going to make a big difference in the taxes that you pay. So the good news is the IRS actually gives a $250,000 exemption on capital gains of a primary residence for any person in the United States. So anybody, regardless of income, whether you're making $30,000 a year, whether you're making $200,000 a year, it doesn't matter. If you sell your home and it's your primary residence and that gain is less than $250,000, it's going to be tax-free. But there are a few requirements that you do need to meet. So let's just do a quick down and dirty rundown point by point. All right, so first, it must be your primary residence. Second, you have to have owned it for at least 2 years. Third, you have to have lived in that residence for at least 2 out of the last 5 years. And 4, you can't have taken this tax exemption within the last 2 years. If you haven't met all those requirements, then you want to talk to a tax professional because you're definitely going to probably owe some type of tax, although it might be reduced. If you have met all of those, don't worry about it. You don't actually owe taxes on the capital gain. Again, assuming you've met all those points and that the gain is under $250,000. All right, so what happens if you've owned the home? This is a long-term capital gain, but it happens to be more than that $250,000. What are some of the tax rates that you're going to need to think about? Well, for single folks who are making less than $40,400, the tax rate is going to be 0. If it's between $40,000, $400,000 and $445,000, you're going to get hit with a 15% capital gains tax. That's where most people are going to fall into that bracket. And if you make more than $445,000, then you're really going to get hit with a 20% capital gains tax rate. So let's talk about married couples because it is a little bit different. So married couples who are roughly making less than $81,000 are going to get the 0% tax exemption. If you're between that $81,000 and roughly $502,000, that would be the 15% tax bracket. And if you're more than that, then it's going to go back to, as we said with single people, 20% tax rate. But you can see there's a lot of leeway here that builds up based on tax bracket. And again, this is only for capital gains that are over $250,000 on the sale of the primary residence. Now let's remember I said at the beginning, if you have owned that property for 1 year or less, that's going to be considered a short-term capital gain. You get that a lot when we see house flipping and things like that. that is going to be subject to your normal income tax brackets. That's not going to get any kind of exemption or be tiered in the same way that the long-term capital gains are going to be taxed at. All right, so a couple of pieces of good news here. I want to talk about a few scenarios in which you can go through and look at and see if it applies to you, or plan on having it apply to you if you haven't sold property yet, in order to reduce that tax burden from the capital gains. Now, the first is going to be home improvements. So you actually can reduce your capital gain by the amount of home improvements that you've been doing. This is why if you're doing major home improvements, if you're remodeling a kitchen, if you're putting on a roof, if you're putting in a new driveway, it's incredibly important that you keep all of the invoices and all of the receipts, because let's say you have a $100,000 capital gain and you've spent $100,000 improving the home, that $100,000 is going to be held against that gain, and you're not going to have to claim the gain or at least get taxed on it because you have an offset with the home improvement. So what happens if you've inherited a property? Let's say mom and dad pass away, they've left you a house that they bought for $100,000, now it's worth $1 million. That's a huge capital gain. Are you going to have to pay that whole difference? No. So for inherited property, the capital gain that will be counted against you when you file your taxes or when you sell the property is only going to be the difference of what you've sold that home for and what it was worth at the time you inherited it. So it's not going to go back to the original sale. So you don't need to worry about that if you happen to be in the inheritance of some property. So what if you don't have a gain and you actually have a loss? Well, unfortunately, if you sell your primary residence for less than what you bought for it, you're not going to really have any net effect on your income tax for that. That's not going to really help out. However, if you're selling other real estate properties that you own, like investment properties and things like that, you can claim some of those losses against your income for that year, although you'll want to talk to a certified tax professional to figure out how much, because there's probably going to be some limitations on how many losses you can claim in any given particular year. So always my advice, speak to the professionals. I'm the real estate guy, somebody else is the tax guy, and there's plenty of great ones in the area. If you need a reference, give me a call, shoot me a text, and I will send you over to my personal trusted tax professionals. I'd be happy to share any of that information with you. All right, so the last quick piece I want to go over here, and this is for all of you real estate investors out there. Now, if you've been an investor for a long time, I'm sure you're very familiar with this, but if you haven't been, or you've been thinking about investing, or you're selling a second property, really important to understand this. And this is what happens if you sell a property that's not your primary residence and you have a big gain on the sale of that investment property. Well, yes, definitely that capital gain is going to count against you when it comes to filing your taxes, but the IRS does have a rule that's called a 1031 like-kind exchange, which means that you can take the profits from the sale of real estate, that capital gain on the real estate, and you can put that money into another investment property. So you're essentially switching one investment for another. That's why they call it the like-kind exchange. And if you do that and do it successfully, again, you probably want to speak to your tax professional so they can guide you through that process to make sure that everything's done the correct way, that papers get filed the right way. You can avoid the capital gain by moving that investment along and trading it into another investment property. All right, guys, so that's really it. That's my down and dirty summary of what is the capital gains and the capital gains tax. Again, as always, if you really have a lot of questions about this, I would love to refer you over to a certified tax professional. If you have a lot of experience with capital gains, or you're worried about a capital gain coming up in the next year, go ahead and drop a comment below. I would love to engage with you on that. As always, guys, I love getting into the comments and speaking to you about any of these topics. Again, my name is Nick Isgro. I'm with eXp Realty here in Central Maine. Thanks so much for sticking around to the end of this video, and until next week, I will see you next time.